and welcome back to Chapter 9, Budgeting for Introductory Management Accounting. This is Part 2 of Learning Objective 2, the Master Budget. People, last videos got a little bit long. I had to take a break and come back to it. All right, so here we are. We're going to continue on from Part 1 of Learning Objective 2, the Master Budget. So if you haven't watched that, please go back and watch that because we're going to be continuing on with that example. Okay, so give this a read and we'll be continuing on. This is looking at manufacturing overhead. Recall, we've looked at how much cash inflows are we getting from sales and how much are we selling from sales. That drives how much we need to produce. The production budget drives how much direct materials we need to buy, how much direct labor is going to cost us, and it's going to drive how much manufacturing overhead we're going to be needing. So here we are told that our manufacturing overhead rate is $20 per direct labor hour. And fixed manufacturing overhead is $50,000 per month, and this includes $20,000 of non-cash costs. So with all of that being said, let us proceed with the manufacturing overhead, the MOH budget. So let us start off with our cost driver, our predetermined overhead rate driver, which is going to be our direct labor hours. And we're going to pull this right from the direct labor hour budget to see how many labor hours we're going to have each month. Okay. And then we're told our MOH rate for variable costs is 20 and going to multiply that across. From there, we're going to look at our fixed manufacturing overhead costs, which are going to be $50,000 per month. And so that looks like that we're going to have a total manufacturing overhead for the quarter of $49.70 per labor hour, except depreciation is a non-cash charge. So we actually need to look at, yes, total manufacturing overhead costs, but then what is our actual cash disbursement going to be? So we need to minus the $20,000 each month for depreciation so that we can see what our cash disbursement, because this static budget is managing both our costs but also our cash required. Okay, so fabulous. We have just ended our DM, DL, MOH. Let us look into our finished goods inventory budget. So after we've now computed all of these costs, for the product, we now have to look at the carrying cost of unsold units. And we need to do that by looking at our ending finished goods inventory budget. If you recall, our production cost per unit from our direct materials items, where we have 5 kilograms per unit. Each kilogram costs us 40 cents. So then it's $2 a direct material per unit. From direct labor, each one of them units to produce took 3 minutes to make, which is equal to 0.05 hours at a rate of $25 per hour for a total of $1.25 of direct labor costs per unit. And our manufacturing overhead took, remember the cost driver is our direct labor, 3 minutes to make. They get $49.70, which is going to be our costs, our total costs. So recall, this includes depreciation because we're looking at total costs, not cash disbursements. So $2.49 per unit, and add these all up, and the production cost per unit is going to be $5.74. So if we have total ending inventory units times by our unit cost, that gives us our ending finished goods inventory dollar amount. So because we had our production budget of $5,000 times that by 5.74, and now we can put in finished goods inventory of $28,700. Okay, great. So now we need to continue on and look at selling, general, admin. These are items other than our manufacturing or product costs. Some case facts are as follows. At Royal, the SG&A expenses are divided into both variable and fixed components. The variable SG&A expenses equal 50 cents per unit, while the fixed SG&A expenses are $70,000 per month. The fixed selling and admin expenses include $10,000 in costs, which include primarily depreciation, that are non-cash outflows for the current month. So with all this information, let us look at our SG&A budget. We can see that our budgeted sales in units are 20,000, so then our variable expenses are 10,000. While the fixed SG&A expenses are 70,000 for total expenses of 80,000. However, it's also important that we see our cash and non-cash expenses. So when we look at our cash disbursements for the month, we're going to remove 10,000 in primarily depreciation to get a total SG&A expenses cash disbursement of $70,000. Okay, so then my question to you is, what would the total SG&A expenses for the quarter be? And in fact, I want to know what are the total cash S&A expenses for the quarter. So give this video a pause, complete the rest of these, add them all up, and let me know what number should be here. I'll see you in the next slide. All right, welcome back. And if you said B, 230,000, you would be correct. Let's take a peek. So we follow this through for our 20,000 to 50,000 to 30,000 units produced at total of 50 cents per unit, gives us $50,000. We have fixed expenses, 3 times 70,000 equals 210 for the quarter. And then we less 10,000 of monthly SG&A expenses to give us 230,000. People, you are getting there. Kudos to you. Let us take a big step back and ask, what is required now? Because effectively, we've worked through the entire income statement while incorporating the relevant aspects of the balance sheet. That is, we've been keeping an eye on cash. We've been looking at accounts receivable, accounts payable. We've been looking at inventory, both at the finished goods level as well as the direct materials level. Pretty comprehensive. We've gone through, so our income statement, our sales, our cost of sales. We've just looked at SG&A. So yeah, time to put it all together. Let us look at the cash budget. So the cash budget pulls together much of this data that we've developed in the preceding steps, and we display it in 4 major sections. Receipts, what we collected. Disbursements, what we gave out, spent. Cash excess or deficiencies. So do we have more receipts than disbursements? Excess. Do we have more disbursements than receipts? Deficiency. And if required, financing. So again, we are going to take into all of our cash receipts, all of our disbursements, determine whether or not we have more or less cash on hand. Do we have deficiency? And then how are we going to manage our financing, including repayments and interest charges? In our example, the case facts are as follows. Royal maintains a 16% open line of credit for $75,000. So that means it's 16% interest. Oh, that's a lot. They require minimum cash balance of $30,000 in their bank account. And they borrow on the first day of the month and repay the loan on the last day of the month when possible. They pay a cash dividend of $49,000 in April. So other than what you saw in our preceding schedules, they also had a cash dividend of $49,000 in April. They bought some equipment, $109,200 in May, and $25,800 in June, all of cash. And we started April 1 with a cash balance of $62,500. Let's plot this out. So we start off with our $62,500. Recall from our accounts receivable schedules that we collect $170,000 worth of cash in April, which means that we have total cash available of $232,500. From there, let us look at our disbursements. In April, we had $40,000 from direct materials, $37,500 from DL, MOH of $56,000, SG&A of $70,000, and then recall from this preceding slide, $49,000 for a cash dividend, which means We had inflows of 232,500 and outflows of 252,500. Anybody saying, what the heck are you doing with this dividend? I am definitely. But they didn't ask us what the problem was this month. They just said, create this cash budget. That's cool. But I'm just telling you that on an exam or in real life, you are like, WTF, this should never happen, because effectively you're borrowing to pay out a dividend, and that's illegal. You definitely, well, depending on where you're listed, but it's if it's not illegal for your listing, it is just bad cash management, because effectively you're going to be paying 16% interest to pay a dividend. That's not cool. Okay, so we now look and we do the math that I just did. You have a deficiency of not only 20,000, but because Royal wishes to maintain a cash balance of 30,000, they must borrow 50,000 on its line of credit. So the 20 plus 30 that they need. Again, WTF dividend going on. They must borrow 50,000 to get up to a cash balance of 30,000. You best believe that next month there's going to be interest of 16% times by 50,000 divided by 12 for that month's borrowing, for that silly dividend. Yeah, you would have had to borrow 1,000, but like, big deal if you didn't have that dividend. Okay, and then ending cash balance, 30,000, exactly as it should be, because we borrowed enough to make it so. All right. Feel free to give this video a pause and do this for the next month of May. All right, so I skipped ahead a little bit, and while I was certain that the interest would be here, we ended up seeing the calculation for the interest for the quarter. So they decided to do a quarterly interest payment. So forgive me in my anger, the 50,000 won't show up right here, but we'll see it in just a second. All right, so, and if you had it here, all good. On an exam, that it will be more specific for sure. All right, so this is for illustrative purposes. So we start off with 30,000, which is where we ended up cash previously. And again, we pull from all of our various schedules into our chart to see our cash available and our cash disbursements. We then see that we come up at the end of May with, after not doing any more dividends, thank you very much, we have exactly enough cash in order to have on hand that we need. So fabulous. So we don't need to borrow, but we also cannot repay anything because we have exactly what we need on hand. All right. So let us do that again one more time for June. Feel free to give this video a pause, and I'll see you at the end. Now we can include the interest. And again, remember, it would go right to the beginning of the month. So they have a rule that when it's borrowed, it would go right to April 1st. So when calculating June, make sure that you take this 50,000 right to the beginning. All right, thank you so much. I'll see you in a second. All right. So let's see. What is the excess or deficiency of cash available for disbursements for June? If you had 95,000, let's see where that would come off in your chart. So if we looked at June, what is you have cash available for disbursements of 95,000. You would then want to pay back your $50,000 from that disbursement for the money that you borrowed in April. You would then also need to pay back 3 months, so 3 full months of 50,000 at 16%, so 3/12 times 16% times 50,000 equals 2,000 that you need to pay back with this excess cash. Dear goodness, if you could have just waited till you had the cash on hand, it wouldn't have cost you $2,000 worth of interest. Cool. But it did, and so you paid it, and now it is going to be $43,000 that you have in your ending cash balance. And when it could have been 45 had you practiced proper cash management and only paid dividends out of excess cash. All right, so regardless, at the quarter, this is what it looks like. Your beginning cash balance would be your beginning at the quarter. your ending cash balance is equal to it ending at the end of the quarter, and the rest of this sums up across. Alrighty. So we've done all of the elements. We've figured out cash. Now it's time to put it all together into a set of budgeted financial statements. So once the cash budget is complete, the budgeted income statement and the budgeted balance sheet can now be prepared. This is where we're going to take all of our sales budgets and times by our sales units to get our budgeted forecasted sales for the 3 months ended June 30th. This is where we'll get our ending finished goods inventory to back us into our cost of goods sold for the 3 months. So how much did we actually sell? Calculating that. We have our gross margin of $426,000 minus our SG&A expenses for the quarter of $260,000, which gives us operating income of $166,000, less that $2,000 of interest expense that we just saw from our cash budget, to give us a total projected, forecasted, budgeted net income of $164,000. Okay, so we have a bit more information before we can prepare a balance sheet. That is land of $50,000, common shares of $200,000, retained earnings of $225,300, and equipment of $175,000. And so those were all the balances that were there prior to preparing the budgeted financial statements. So from there, we can see, great, as at June 30th, remember we had, we take from our cash budgeted, the $43,000, pardon me, we have $43,000. Then you have accounts receivable, which was from our June sales, our collection. So this is the amount that we didn't collect from June sales. We then have our raw materials inventory and our finished goods inventory at the end of June 30th. We have land from the previous screen, as well as equipment, the items from the previous screen, plus what we purchased from our cash budget to give us our total assets. We have the outstanding amounts of purchases from June, as well as what we were told for the common shares and retained earnings. And then we do a little celebration once we balance. Woo! And if you're looking to articulate this through, our retained earnings was the balance that was provided, pardon me, of $225,000. Adding net income, minusing those dividends to give us this ending balance. And now we celebrate. Okay. So these budgets are static budgets. Static budgets are prepared for only one planned budgeted level of activity. As we saw, it was planning based on forecasted sales, and it was great, except if you cannot control for the amount of sales that you actually make. So you saw how sales drove everything. Sales drove cash collected, sales drove units produced, that drove the direct materials required, that drove the direct labor that we contracted, that drove everything, even the variable overhead that was incurred. And oh man, it affects everything. So we really do need an alternative approach to restore the usefulness of budgets as a control tool for when we're not able to accurately forecast our sales and our production. So static budgets are great. We use them. We'll absolutely keep doing them. But there is an alternative, which I will discuss in our next video. Thank you so much for your attention, and I'll see you there.